You probably went through what we witnessed today a dozen or 20 times if you looked back at the big move in silver from 2010 to 2011 or 1979 to 1980. Silver prices fell by 6% on Monday and Tuesday, the 13th and 14th of this week. So, is that correct? It was a 6% drop on Monday and Tuesday. After setting a new high earlier today, we had a 6% decline. I get it. Today is the day that options expire. No, I understand now. Simply said, something happens nearly every time you reach the option expiration day while you're trying to settle it. Yes, I understand. Our surplus has grown from $30 to $50 in only a few short months, proving that it is ineffective. As a matter of fact, silver's settlement price is currently going to be 6% higher than last week's final price. Yeah, two 6% sell-offs this week, mostly for the same turf. Ruined everything? Even though we're 6% ahead of where we were last week, nobody seems to be celebrating. Everyone laments the arrival week. I'm simply warning you that in the coming months, you will receive an increasing number of such. Every time you see one, though, it's terrifying, and your buddies always tell you to purchase one since it's the best. In all honesty, you're better off investing in the 5% to 6% breaks rather than the upside breakouts. Going from 10 to 100 is a tenfold since it's a ratio. This is a tenfold increase from 100 to 1000. They are identical in size. Thus, the chart is a log scale ratio. In 1976, little over a year and a half after gold was legalized, the price hit a high of 200 before plunging to 103. You had to be careful then. It increased from 103 to 850 in the 3.5 years that followed. There are 8 moves in that. By the way, a lot of stuff happened in the final 6 months of the relocation. However, following that, gold remained quite stable for a few decades, moving in a sideways pattern of increases and decreases while maintaining a level of support significantly higher than its low point in 1976. It re-engaged in 2001 at a low of approximately $260 before stalling again. Hence, 2.5 times the 1976 low price. You hit a low of $260 in 2001 and are now at 1960, a full decade later. Yes, yet another eightfold maneuver. Comparable to the initial move in terms of dimension. However, the time interval is different. Next, what were your actions? You had to enter a new reality of gold spanning many decades instead of the one that existed from 1983 to 2000 or thereabouts. Another benefit is now at work in you. Now, when looking at mathematical charts of what has transpired, say, over the last year, everyone is shouting, "Oh, it's overdone," they express. Either we fix it or that's it doesn't matter. In both of those earlier movements, we have merely scratched the surface. 4 times the last bear market bottom of $1,043 in December 2015, we are now at 4,200. That means we've gone over 4 times. To at least claim that gold has done the same thing twice since legalization, you need to go to 8,500. This time, though, the circumstances may be far more fundamentally and globally significant than anything that sparked earlier movements. In particular, central banks debase money units when they are worried about data points and asset categories that matter to them, such as banks, stock markets, etc. The fundamental currency's value is depreciating nonetheless, so when they step in and print additional money, it means they're trying to hasten the inevitable. Everyone thinks it's too early, even though we're only halfway through the dimension of the 2 previous bull markets. My opinion is that it won't. Take a look at the truth below. It's very cool, actually, since it differs from the gold version. In the same way that gold fluctuates monthly and quarterly, so does silver. This is not an error. Another unit of currency that has a real-world history dating back 3 centuries. In the same way that gold had a massive movement from its low in 1976 to its high in 1980, it did the same. Nonetheless, the price of silver increased from around $6 to $50. However, it subsequently entered what else? Once again, we have a dull position with limited movement, this time between $10 and $11. From that same low, it had another bull run. After that, silver rose to 50 again in 2001, coinciding with the resurgence of gold. Once more, it was struck. Although this does not display highs within a single month, the left-hand peak in 1979 reached more than 50. Prices in the 30s are considered excessive. However, when looking at the intra-month, they were identical to the high from 2011. After that, what do you do? Similar to how gold has been mostly flat since its 2011 peak until around 2020, you will have a period of monotony for the next 10 years. I understand. Silver has just surpassed the 50-year range's high point this past week. This is just a price chart, and that's all we're discussing. And I say it's stupid because if silver were to reflect the depreciation of the US currency from 1980 to the present, or even from 2011 to the present, its value would be $200 or more at this exact moment. I understand. Something resembling the gold chart, which makes up for the persistent depreciation of the currency. Though silver hasn't accomplished that. A copper chart is actually at my fingertips. Looking back to the 1970s and 1980s, you can see that it followed a pricing range from 1970 to 1990, and then into the 2000s, where it remained in a horizontal range until around 2005. And it jumped out of that area and quadrupled in half the year. 2005, I believe. Excuse me, but that is incorrect. The amount increased fourfold. It removed a range spanning decades and nearly doubled in price in just 6 to 9 months. I have been living in a new price reality relative to the old range since then, since 2006 or 2007, in another large sideways range. Silver is only now beginning to shake off a price reality that occurred 50 years ago. Accordingly, silver is, relative to many other assets, significantly behind. I have a lead chart that I can show you. Rather than arguing that silver has fallen from its highs, we are focusing on momentum and spread relationship variables in respect to gold. In the next several months or quarters, silver's price will explode out of its current 50-year range and into a whole new world. And I predict that number will be 100 or more. The more probable number is 200. A lot of that, in my opinion, will happen in the next half year. Additionally, we are keeping an eye on one key signal metric for that. Nor is the cost. It is not price momentum. There is currently a bull market in silver. It's not a problem. What matters is that it goes berserk on the upside at what point. And when we looked at the last few months of the rise in 1979 and 1980, we saw that it jumped from $10 to $50 in the last 5 or 6 months. Boom. A couple of years ago, there was a bull market that lasted for about 5 or 6 months. And you rewind to that moment in 2010 when you felt that shock? It was somewhere between $20 and $50, I think. In other words, it nearly quadrupled in that time frame. It had been increasing for quite some time. Thus, there is no problem. Already, silver was a bull market. Why, though, did it go completely bonkers in the span of a few months? An indication of signal strength was the spread's link to gold. Not silver's momentum or dynamics, but the spread between silver and gold's momentum and dynamics. At this time, that spread is positioned below structural levels, beginning at the beginning of the month and continuing until the present. Quite clearly, you can see that. Yeah, by the way, that is the ratio of silver to gold. Yeah, we're specifically looking at the year 2020. That was a significant spike. During that period in 2020 and early 2021, silver had a rise. You're reliving the year 2011. Yeah, that surge over there is the one we're examining. From that crevice, we emerged. Silver also fared far better than gold from 2020 until early 2021. Although both silver and gold have been on the rise in recent years, the spread has worsened. That margin has now surged again, this time significantly since April. When you rise above the recent highs, you'll see a breakout on multiple measures of that spread that indicate you're about to leave this area. We don't plot your trend line. Our trend lines are different. Well, my point is that the recent silver rise is putting pressure on the spread's momentum and the spread itself to the point that it threatens to launch again if the current trend continues. At the previous turning point, silver also went from up to drastically up. Silver hasn't done that in half a century, as you can see from the first charts I gave you. While many other commodities have seen their long-term price ranges eroded, silver has remained relatively stable. As for silver, I predict it will soon play catch-up. Plus, anyone who has spent any amount of time in the market knows that markets are fallible. You can look back and say, gee, I guess it was excessive when the stock market bubbles burst and the subsequent crash buries the previous bulls. I ought to have departed sooner. In most cases, it makes up for its previous excess as it falls. After a prolonged period of low prices, the same holds true for markets. Their mood is still down. Their mood is still down. People tend to ignore them. Oh, nothing's happening there, they say. Put it out of your mind. Whatever it is, they choose to reject it. However, you must account for certain circumstances, such as those pertaining to fundamentals and so on, as well as the underlying deterioration of the money unit. The cumulative effect of all those elements is immense. Oh no, I messed up, the market says lastly, and it erupts out the hole with a rumble. Like a bubble top popping, it makes up for the mistake. Silver, in my opinion, is about to make up for the mistake. In addition, I do not anticipate a 2-year price trend upward to a new reality. It will most likely reach that point in a few quarters and then adapt to the new pricing reality. And I believe the truth will be somewhere. 100 at the very least wouldn't shock me. And let's be completely justified if you consider, once again, the depreciation of the US currency, actual purchasing power. In my opinion, we're almost there. Plus, it needs to be dramatic. People shouldn't have months to consider this type of investing opportunity. People who aren't there will miss it. And just like that, you're transported to an other world. It has occurred in a number of marketplaces. It can bore you to tears with charts of basic commodities and so on, stretching back decades, demonstrating how a particular asset remains so low for so long that it goes unnoticed. Oh no, I just made a mistake. And then it vanishes. Quarters bring forth a new reality. In my opinion, we're almost there. Sure, how about we check out the silver chart? It's available right now. Today we experienced a massive 5% decline. Since when was the last time silver was this low? Oh, more than 2 days ago. It is growing 5% to 6% week to week, though. I apologize. Absolutely, we're right back where we were on Wednesday. How awful. On any case, silver futures is something that we keep an eye on. In my opinion, this is the place. Regardless, today is the day that options expire. As a result, it's safe to assume that certain financial institutions lend a hand when the market drops. No problem. Many long-term investors are considering cashing out their positions. Additionally, I can't stress this enough. The price of gold is 4 times what it was during the bear market trough. It has seen 2 8-fold bull markets in the previous 50 years. It hasn't even been shown to you yet. Suppose silver, as we anticipate, catches up, but in the form of a thunderbolt. So not only may gold just repeat the 2 previous bull markets, which I predict it will do much better than, but silver will eventually close the gap. It will be a monumental change. The question remains, though, what was the highest reading for silver relative to gold on a percentage scale, looking back 50 years? Additionally, the current price of gold is 1.2%. 20 out of the last 50 years have seen rates of 2% or greater. To return to the norm of the last half-century, even a modest increase to 2% or more would need nearly double the current silver valuation. Looking at previous bull market years for silver relative to gold, silver and gold in general, or 79-80 baby as an example, 2010, 2011, we see that spread was at least 3% in 1980 and as high as 6.5%. Now, if we increased it to 3%, the present value of silver relative to gold would triple. Calculate it yourself. If gold reached 8,500, which would mean nothing more than repeating its 2 previous peaks, and silver reached 2% of that, silver would be 160. You would understand the situation if silver dropped to 3% of that. Not only will silver eventually catch up to gold in terms of relative performance, but its net price will also rise soon. In addition, I anticipate that the scenario will be highly condensed.